The global economy is vulnerable as central banks fight inflation. Increasing prices affect the industry, financial institutions, and global living standards. Discover how this fight against inflation reshapes the global economy and forces politicians to balance. The global economy is struggling with chronic inflation. Central banks and policymakers are battling inflation, but their decisions have far-reaching effects. Raising interest rates and tightening monetary policies to fight inflation are changing the global economy. Industries, financial institutions, and people struggle with rising expenses. This introduction prepares us to examine the global economy's complicated fight against inflation. Encountering the inflation. The downside risks were growing, a key message conveyed in the IMF's latest World Economic Outlook. The battle against inflation was becoming a pressing concern for the global economy. Inflation rates were soaring unseen in decades worldwide, prompting central banks to raise interest rates swiftly. This aggressive measure aimed to cool down housing markets and slow economic growth. However, the consequences were not limited to these sectors alone. The impact on banks became evident in March when several financial institutions in the United States and Switzerland faced failure. Fortunately, policymakers took decisive action, implementing strong measures to stabilize the situation and prevent the problem from spreading further. Their swift intervention successfully contained the crisis. Despite the efforts made thus far, the fight against inflation was expected to be prolonged. Economies would continue to grapple with the challenges posed by rising prices, and policymakers would need to remain vigilant and take appropriate measures to address the issue effectively. Banking crisis. The European Central Bank conducted a 3-day seminar for global central bankers and policymakers in Sintra, Portugal. Before this conference, central bankers discussed the turbulent last few months at the Bank for International Settlements (BIS) annual meeting. They recognized many U.S. regional bank failures, notably Silicon Valley Bank and Credit Suisse's emergency bailout in the BIS's jurisdiction. BIS statistics showed that 15% of rate rise cycles cause serious banking system stress. However, rising interest rates, inflation, or home prices increase this frequency dramatically. The first rate rise might cause 40% severe stress if the private debt-to-GDP ratio is in the top quartile. The BIS highlighted that the global economy had high debt, inflation, and property prices. The BIS also predicted that over the next 20 years, advanced and developing market countries would spend 4% and 5% of GDP on aging populations. Without expenditure cuts, debt levels in industrialized and emerging nations might reach 200% and 150% of GDP by 2050. The paper also proposed a new financial system with central bank digital currencies and tokenized banking assets to transform global commerce. Former Mexican central banker Agustin Carstens urged authorities to act. He advised correcting excessive expectations about the size and duration of monetary and fiscal support after the Great Financial Crisis and COVID-19 epidemic. The BIS still believes in a smooth landing for the economy, where rate hikes don't cause recessions or financial crises, but they recognize the current situation's complexity. Bank of America analysts observed that there had been 470 worldwide interest rate hikes in the previous 2 years, compared to 1,202 cuts since the financial meltdown, signaling a change in monetary policy. Central bankers have issues as firms take advantage of the situation to increase profits, and employees seek a greater pay to maintain their living standards. A senior BIS official, Claudio Borio, stated that the easy gains had been made, making inflation control more difficult. He warned that the road ahead might be bumpy. Impacts of uncontrolled debt conditions. Global economies are tough. The narrator considers cautious interest rate rises. A strategy change is needed if borrowing circumstances deteriorate. The Fed and ECB raise interest rates under the baseline scenario. This international approach attempts to gradually return inflation to its targeted levels by 2025, but only after that. The narrator proposes a lengthy fight against inflation if the financial crisis remains subdued. In this case, central banks may fight inflation while using mechanisms like liquidity supply and depositor insurance to handle bank difficulties. However, the narrator predicts a financial crisis that surpasses expectations. This requires a strategic change. Central banks must prioritize financial system stability. If they do this, they must properly signal that inflation remains a primary issue once the financial situation improves. When will inflation come down? It was going to be a long and challenging journey for the economies. As the clock struck, the need to understand their current position in this process became apparent. Each passing month brought news about inflation. Unfortunately, the last few months had been disappointing. Underlying inflation had stubbornly plateaued instead of showing signs of decreasing. This posed a significant concern for many countries. Amidst the discouraging circumstances, there was a glimmer of hope. Oil prices were anticipated to decrease by around 24% in 2023, offering some relief. However, despite this positive development, nearly 97% of countries with an inflation target would miss it considerably in 2023. The outlook for 2024 was the same, leaving little room for optimism. The real test would come in 2025. Only then would there be a clearer understanding of whether the economies were getting closer to achieving their desired goals. Until then, the road ahead appeared arduous, with many challenges and uncertainties waiting. The economies would need to navigate these obstacles and patiently wait for signs of progress, hoping the eventual landing would bring them to a more stable and prosperous destination. Markets imbalance. The international community recognizes the significance of emerging markets and developing country debt crisis. Many nations who borrowed substantially in dollars require help repaying their debts due to increased interest rates, reduced growth rates, and a stronger dollar. According to estimates, 60% of low-income nations are in debt trouble or at risk of default. 25% of rising market economies are also high risk. Global stakeholders fear massive defaults and restructurings. The international community must prepare for a major change, recognizing the looming threat. How can the world prepare for such a crisis? International organizations and financial institutions must first monitor vulnerable countries. Policymakers can see danger indications and respond quickly by monitoring economic indicators, debt levels, and repayment capacity. International stakeholders must collaborate. Collaboration improves crisis response by sharing knowledge, skills, and funds. Supporting debt-stricken nations is crucial. This might include debt management and restructuring skills, financial help packages, or debt relief procedures. Talking to impacted nations and finding mutually beneficial solutions can decrease the severity of defaults and their long-term effects on debtor nations and the global economy. Preparedness involves proactive monitoring, international coordination, and tailored aid. These strategies will help the international community handle the probable wave of defaults and restructurings, reducing the effect and developing more resilient economies. Role of the international community. Amid a high-level meeting, the speaker emphasized the urgent need to address the mounting debt levels. It was abundantly clear to everyone present that immediate action was required. A section of the report had just been revised, focusing on various strategies to alleviate the debt crisis. The speaker suggested austerity measures and tax increases. However, depending only on these methods would often fail. Debt renegotiation and restructuring were needed. G20 shared frameworks supported such efforts. This system required cooperation between countries funding debt-ridden states. International collaboration was emphasized, and the spring meeting's roundtable talks will address these issues. These conversations promoted teamwork and a unified plan. The goal was to lower the loan face value and terms to relieve debt-ridden countries. By collaborating, the leaders intended to solve this global challenge. China's take against the global inflation. In the global economic outlook, China holds significant weight, making it impossible not to discuss its role. By 2023, approximately one-third of the global growth is projected to originate from China, marking a substantial improvement from 2022, when China experienced its lowest growth rate since 1976. With the reopening of its economy, China is expected to achieve a growth rate of 5.2%. This growth will have ripple effects throughout the region, leading to increased Chinese tourists and a surge in service demand. Furthermore, China's role extends beyond economic growth to debt restructuring. Many countries have borrowed loans from China, and addressing the issue of unsustainable debt is crucial. In this context, China's active involvement in resolving the debt crisis becomes significant. Its presence at a negotiating table holds the potential to find viable solutions for countries burdened by mounting debt. However, it's important to note that there are varying approaches and perspectives regarding China's involvement among different nations. geopolitical to geoeconomics. US, EU, and French geopolitics were discussed. The speaker warned of geoeconomic fragmentation, with nations siding with the US or China. They believed this split would hurt the global economy by decreasing efficiency in foreign direct investment. The speaker admitted that Vietnam might profit from Chinese investment redirected elsewhere. However, the international economy would shrink, making even middle-income nations net losers. Fragmentation increased uncertainty and made reaching a consensus on global issues like climate change and debt restructuring difficult. The talk quickly stopped and moved on, leaving the reader feeling unsatisfied. Thank you for joining us today. We hope you found this video helpful. Remember to subscribe to this channel for more insightful content on the economic world.